The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen. Thank you very much for being with us today. Good morning to my friends in the lands down under, at least those of you on the East Coast, and good afternoon across the ditch in the land of the long white cloud. How's the volume, folks? Can you hear me all right? Would somebody please type in the question box if you can hear me and how the volume is? Yes, here we are. Good, Mike's got it. Thank you, Mike. You can hear me? That's great. All right. So we have so much to talk about today, folks. And those of you who, hello, Gig. Yeah, good, mate. Halfway around the world. That's quite right. All the way over there in North Carolina. Let's see who's with us today. Al's with us, which is great to have. A few people coming in a bit late now. Andrew's with us. Here we are. Benjamin's with us. Oh, everyone's coming in now. Look at this. Let's go thump, 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 thump. Benjamin's with us. Bill's, of course, with us. Let's have a look here. Brian, yes, Carol. Welcome, Carol. As I say, we don't have many ladies at the Danielcode for some reason, but we do love having you with us, so that's grand. Colin's with us. Dave V, of course, he's a tutorial guy. So's Jean-Philippe Ducaux. Welcome, my friend. Good to have you with us. John David's with us, of course. Donald, Francisco, haven't heard from you for a while. Great to have you with us, Francisco. Gary, George, Geek over there in North Carolina. Here we are. Greg, the wealth manager over in Colorado Springs, whose son knows what a fortnight means. Janet, great to have you with us, Janet. Oh, gosh, she's been with us probably longer, one of the longer members of the Danielcode. Wonderful. And Jeff's with us. He's a tutorial guy. Joel from Vero Beach, of course. John H. He's a new tutorial guy. Been trading. He's a prop trader for Forex, and I'm suggesting to him that he might be having a look at some futures as well. And here we are. Mark's with us, of course. Mark L. He's always with us. Michael Peel, great to have you with us, Michael, wherever you are these days. I'm sure it's somewhere interesting and exciting. He's a great traveller, Michael. Mike, the Murph, is with us. And, oh dear, here we go. Lots of people coming in. Great. Mark Nathan's with us. Norbert up there in the cold country in Canada. Peter with us, the short-term trading guru from east of Brisbane, Australia. Philip's with us. Randy's with us. Randy, gosh, so many years since I've spoken to you, my friend. He's been an absolutely staunch Danielcode member for years and years and years. Rocky's with us. He's a new client. Rolf's with us down in Melbourne. Rolf has been a Danielcode member many years ago and back getting interested in trading again now. Sean, of course. Stephen, and of course Toddy T down there, over there on the west coast of America. Wonderful to have you with us, Todd. He's a very long-serving member as well. Anyway, folks, lots to talk about today, so let's get on with it. Those of you who keep count will notice that this webinar has come on a non-scheduled date. I usually do these webinars every fortnight, which means 2 weeks. I know it's an expression Americans don't use much, but it's a pretty common expression down under. And a fortnight is literally 14 nights or 2 weeks. But last week, I spent a lot of time going over Bitcoin and Ethereum and their futures contracts, trying to explain what they were and what the opportunities were. And I got precisely 2 emails about that webinar. One said, I'm not remotely interested in crypto, but I have got some puts in the S&P, and I'm very annoyed that you didn't deal with the S&P. That was one of them. The other was a gentleman who said, well, I really enjoyed the webinar and I really enjoyed learning this stuff. Boy, I'm glad I'm not in Bitcoin or Ethereum, or Ether as the futures contract for Ethereum is called. So I thought I'd better put in a quick one here and get everyone up to date on what's happening with equities, because those of you who know that something big is brewing, and you need to be right on top of all of the signals now. So let's move on and see what we can offer you here. So here we are. You know that these markets are rational, orderly, and sometimes predictable. Well, they pretty well have to be, don't they? Because that's how we get our signals, which are staggeringly good, in my opinion. And of course, the thing that's on everyone's mind at the moment is the fourth seal. And make sure you subscribe to it now more than ever. Frank DB's weekly updates give you the go, no-go signal. So basically what's happening there is that Frank, who runs the fourth seal for me, he was a student. He came to a tutorial, Danielcode tutorial, when we were in Taupo, New Zealand, in 2011, as I recall. And that was the very first time I taught the fourth seal at a tutorial. And he latched onto it. That became really his thing, and he focused on it. I spoke to him earlier this week, actually, and he can tell me the exact time of that tutorial, the exact moment that I was teaching the fourth seal, and he just fell in love with it. And he's dedicated himself to it and done very, very well. He's a very clever young man. But remember that the situation at the moment is that the S&P is tracking a previous very long-term pattern, and that's about to expire in the next few weeks. Now, remember, when we get down to a 6-day chart, in fact, for any chart, remember that these time cycles are valid for plus or minus one period, and that's because it's valid to start the time count from either a swing high or a closing high, so long as the closing high is within one bar of the swing high. So that gives you that reason for that plus or minus one period variance. So if we're taking the possibility of a 3-week period, plus if we have a week where the signal expires, then we're interested in the week before and the week after as well, because of the fact that these signals are valid for plus or minus one period. So in the Monday updates now, Frank is giving us the go, no-go signal, whether the market continues to track the pattern that it has been tracking for a long time now. It's a very long-term pattern. So you need to make sure you read that update every Monday and keep right on top of it. So we're now going to talk today about time cycles, because that's what the big interest is now. These time cycles come from the two most important numbers in the trader's universe, 1290 and 1335. And they do seem quite innocuous unless you've done a tutorial and you've followed how I extracted from those numbers the basic number for time, and the instruction on how we count time is equally simple. It shall be for a time, times, and an half. So from that, once we have the base number for time, we can get the various progressions that come from it. And those Danielcode time cycles are exactly the same as you see every day in the red and black lines on your members' charts. Those are price retracements, but the time cycles are exactly the same. Or put another way, time and price are the same thing on different axes, and you're going to see that today because I'm going to take you on a journey of time cycle turns. So if you're interested in this, and you should be, we have a number of different charts to choose from. So we've chosen the S&P as our standard bearer for the equities, as the broadest representation of institutional portfolios. But within that banner, we could choose the big S&P chart, the mini S&P futures charts, or the index, and the difference is subtle but real. So be aware of it. And the most important of all of those is the S&P index. The index is the gold standard. Most of the time, the futures is pretty closely aligned, but at some key points they diverge. So be aware of that if you're looking at doing this sort of analysis. Make sure if you're looking at equities that you've got the index. You're looking at the index as well as the futures. And the most famous of the Danielcode time and price calls came in March 2009 at the end of the subprime mortgage crash, when we called that low pretty much to the day, and to a handful of points, or a handful of ticks even, away from the 666 low. And if you're interested in how that all panned out, go to the articles tab at the Danielcode website and read the article that's called The Number of the Beast, and you will see exactly how that all transpired, and it really was quite extraordinary. So here we are. To forecast the end of that subprime mortgage crash, we had one of the dominant DC time cycles, and we saw that had occurred. So I looked for it to repeat, as cycles often do, and that's exactly what it did. So I generally use the S&P Emini chart for most of the time cycle work that I do for our webinars, and it matches the index most of the time. But remember, the index, $SPX, it's the gold standard. It's the ultimate arbiter. So let's see how they were different there. So this is the 2007 high and the 2009 low. This is the subprime mortgage bubble that eventually exploded. And you can see on the futures chart, this is the E-mini futures chart, that the first cycle into the high was 62, swing high to swing high, 62. That's a Danielcode number. That's a valid Danielcode time cycle. And from that high, which has the blue line on it with the 62 at the bottom, it was 59 down into the closing low, the bar just before the swing low. So both of those cycles are valid, but they're not exactly what happened at that time. So this is the index. This is the same chart, but this is actually the S&P index. In other words, this is a price established by the value of the total of the 500 stocks that are in the S&P index. And you can see this is different. It actually went 59 to 59, and it went closing high to closing high at 59 on the first hop. When I say the first hop, that's the first 59 cycle. It can go on and repeat and become another 59 cycle, which is exactly what it did here. And from that closing high, it was 59 cycles, or 59 lots of 6 days. These are 6-day charts, to the closing low. And that's how we got that call for the probable low of the subprime crash. Fortunately, I was actually running a tutorial in Taupo the week of the low came in, which we had at 666 in the blue line. And fortunately, we have members with us. Some of them are here with us today who actually came to that tutorial, or knew people who did, and can say, yes, we know that that's exactly what happened. And that's interesting, because when we call that low, I can tell you it Not many people believed that was going to be the ultimate low. And within a few weeks, of course, everyone claimed they'd found that low, which is rather interesting because at the time there was a stunning silence apart from at the Danielcode. So bear in mind that there is a difference sometimes between the futures charts and the index, and the index is the gold standard. Okay, so remember when you're looking at these charts, we have chart highs and lows, we have closing highs and lows, we also have chart highs and lows and true highs and lows. The difference between the chart high low and the true high and low becomes very important as we slide down to the daily time frames. And for the longer term charts, you'll see that the turns excuse me, are controlled by Danielcode time cycles from significant highs and lows. And daily charts, if we get down to that time cycle, they're much more influenced by the lunar cycles, as you've seen from our previous webinars. So in the beginning, the long-term forecasting, we use a 6-day chart. Each bar on that is 6 days, and we then have multiples of that. We use 12 and 24-day charts, and sometimes 48-day charts. That's pretty unusual, but I know that FrankDB uses 48-day charts quite frequently. And as I say, remember the variance is plus or minus one period, and the reasons for that variance are the aforementioned ability for time counts to start from either a significant high-low or the closing high-low if it is the immediately preceding bar. So let's have a look at how true this stuff is. If we've got a hypothesis that markets are ruled by the Danielcode in time and in price, then we ought to be able to prove it. It's not much of a hypothesis if you can't prove it. It's only just an idea, isn't it? So let's go all the way back to 2000, the dot-com bull market. Many of you were trading at the time, and this finished up becoming a fairly dramatic move. But notice how slowly it started. So at that high, which was March the 24th, 2000, that was in fact the day that the 6-day bar expired. You had 1, 2, 3, 4 time cycles either on that bar or on the bar immediately afterwards, and they're all known Danielcode time cycles. Have a look how long it took to develop. You got a little pullback down there, and then you had a rally. Bearing in mind that these are 6-day bars, it took quite a lot of time before it started to get some momentum downwards, and it wasn't really until I guess September. So you had the top in March. It really wasn't until September that we started to get some real downward momentum. So don't expect a flash crash if we get a turn on the fourth seal in the period that we're interested in. The normal pattern is that it takes time for trends to change, and which is what we're expecting with the fourth seal. So don't be in a rush thinking it's all going to happen at once. The probabilities are that it won't. Now we move on, and we've got down to the low of the dot-com crash, or in fact it was a correction, wasn't it? And we've got 1, 2, 3, 4, 5 time cycles all at that low. And look at these numbers, 29, 44, 62, 70, 74. You see these numbers on your price charts, your members charts, all the time because they're exactly the same numbers. Time and price are the same thing on different axes. And I know that's a hard concept to gather, but this is the proof of it. You're seeing it now. So from the dot-com correction, we wandered along, and eventually we got to the 2007 top. This is the S&P Emini chart. You've already seen the SPX, the index chart. But notice how this is different. You still get your same information. You get 3 time cycles, all at the swing high bar, you get one time cycle comes a day before. I correct myself, one of them also came, it's not when I say a day, I mean a 6-day period, a 6-day bar before, which was actually the closing high. And that's where the next swing time count to the low comes from, the closing high in 2007, October 2007. So exactly the same thing, all of those signals there now. Have a look at this. This is what happened in the 2009 low. Well, you say, what that's got to do with us now, that's history. But history is important, particularly with anything to do with trading, because markets have a memory and they repeat. They don't always do it exactly. The expression is they rhyme rather than match, but markets have a memory and they tend to do the same thing again and again and again. So in this one, this is the index again, so you can see clearly the 59 cycle runs from the swing high to the closing high. In fact, the swing high where it starts was also the closing high. So we had a 59 cycle closing high to closing high. That's the crash cycle. Unusual to see it, and there it is. Then from there, from that closing high, we had 59 to the closing low. And we also had a 50 down to the 6-day bar, one period past the closing low, which was actually the chart low, the swing low. So there you can see the three signals where two of them landed on the closing low, one of them landed the next period, which was actually also the swing low. Bear in mind that when you're looking at your 6-day, 12-day, 24-day charts, if you're interested in that, your charts may be slightly different to mine. And that's because it's a function of whenever your data starts, which depends on when you became a member of Trade Navigator or started using their software, and B, how much data you've downloaded. So your charts won't be exactly identical to mine, but as I say, the allowable variance is plus or minus one period. So if your charts are starting at a slightly different time, it doesn't matter. So from that important swing low, we had lots and lots of price action going up and up and up and up, and we had a couple of corrections there. But the most dramatic of them was the February-March 2020, where the market covered 4,871 ticks from high to low in just 23 days. And I'm going to show you that now. So this is how it looked. This is the S&P Emini chart, and you can see we had 3 expiring time cycles on the swing high. That was the big grey bar there. And we had 1, 2, 3, 4, 5 expiring time cycles, either at the low, the bar before the low, or the bar after the low. They all count as valid time cycles, plus or minus one period, to get that low on the 6-day chart in the 6-day period ending March 23rd, 2020. That was a wild time, wasn't it? It's unlikely we're going to see something like that again for a while. So this is the 48-day chart, which you can see is showing you exactly the same thing. This is the same crash low, the February crash low, 2020. And you can see that it was 59 from the major cycle low in October 2009, and 59 on the really long-term chart. This is the 48-day chart. I don't use this often, but it's interesting to see how it all ties together. We had all of the time cycles on the 6-day chart at the high of that move, and you can see we also had 59 on the seriously long-term chart, 48 days to a bar. Now, time cycles can start from expiring cycles, You can see here, again, this is the S&P Emini, and we had a time cycle expiring in July 2014. And there it is at 59 from a previous high, and then it went 59 up into the June 2020 high, which gave us that fabulous flash crash. The shortest bear market in history. Boy, that was great trading, wasn't it? But we see exactly the same thing on a longer term chart. If we move out to 24-day chart, you can see there's your first cycle of 59, and then it repeats again to give you exactly the high of the March 05 flash crash. So a lot of people were taken by surprise about that, but there was no need to be. The time cycles had all aligned at that point. Now, it's important to note that the Danielcode per se is mute on quantum. It doesn't tell us about quantum. It tells us about turns, and it tells us about continuation signals. But once those turns or continuation signals have been elected, what happens after that is a matter of your trading skill. And if you are able to tell the trend, the likely trend, the probable trend, I call it, because everything to do with trading is about probabilities. If you can tell the probable trend within one bar from a turn, which is what I teach you to do at the tutorials, you're going to have a massive advantage over everyone else in the industry. So we're thinking about what's happening in June. Have a look at this. There's just a ton of time cycles. This is the 24-day chart, and as you can see in the bottom part of that chart, we had two time cycles expiring at the flash crash, the March 2020 flash crash swing high, one expiring at the bar immediately before, which was the closing high of the rally, and at the low, we had one at the chart low, and one came one period. The 50 cycle came one period after the low of that flash crash. And if you look up higher as we go into June, there are at least 1, 2, 3, 4 time cycles expiring in the month of June. This is a 24-day chart, so this is the equivalent of a monthly chart, if you like, Danielcode version of it at least. And the red line, as you can see, is a fourth seal line. That is an angle. The fourth seal is actually an angle. An angle has connotations of both time and price, because any point on an angle will have a measurable price and a measurable time. And that's how I started my research on the fourth seal, and of course from that comes the time cycles that we're looking at now. So let's move on. Let's catch up to date with the latest correction. This is what happened about 5 weeks ago. We had a 50 cycle high to high, and we looked for it to repeat, which it did. And the bar that the arrow is on, which says this is the closing high, it isn't anymore, but it was for the next 3 weeks or so. But all corrections will start with a time cycle. There'll be a dominant time cycle, a major time cycle. 50 is not one of the usually dominant cycles we see, but it worked well enough here. So from there you move on to your Danielcode members charts. Remember, you can't actually trade a 6-day chart, a 12-day chart, or a 24-day chart with futures, because the leverage is too big and your risk on management is way outside your risk management program. So once we think we have a time cycle, a valid time cycle, we then go to our members charts, and this is exactly what we're looking for. This was how the present correction started off, with a TO3 and a blue line sell signal. Now, these charts are posted on Sunday, Monday and Thursday, your Saturday, Sunday, my Wednesday night. they're refreshed, and if they happen to go past the visible number of support and resistance lines that I'm showing you, they'll be updated the very next day. So you have this data in front of you in members charts every day. And then this is what happened in this particular swing. We had a TO3 and blue line sell signal. Down it went to the black line at 4121, and that gave us a TO3 buy signal, which took a couple of days to develop, but eventually it grabbed itself. 2 days later, we're on daily charts, and off it went, straight up again into the blue lines, and we actually had target recognition on that up bar, which was the bar that set off the little sell-off there. That was a correlated sell signal, which correlated with Dow and NASDAQ TO3 sell signals. And I tell you often that US equities, Russell, Dow, NASDAQ, S&P, and Germany's DAX are so highly correlated that a signal in any one can be executed in any other of those markets, provided the trade is elected. So those of you who want to trade the NASDAQ or the Russell or the Dow, you can trade all those markets because they're so highly correlated with the other US equities and Germany's DAX. So we started off with a correlated signal, which was also incidentally coming from a blue line. And down it went. And you can see that 1, 2, 3 bars down, you had a really big bar that closed at 4052, right on a blue line. Now that bar gave you the VTE signal, valid to exit. Those of you who follow the Success program will see me posting that occasionally. When a bar is valid to exit, it means that it's valid for you to take your profits there at the close and say thank you very much and wait for the next signal. Those of you who've done a tutorial know why that chart is why that bar is a VTE bar, because you can define that very clearly if you've done a Danielcode tutorial. For those of you that haven't, remember that volatility can increase very quickly when this market starts to move against its established pattern. In other words, this market has been up, up, up forever and ever. When you get a sell signal that has a bit of bite to it, the size of the bars increases very rapidly. And I mean really rapidly. Some of these bars are like $6,000 or $7,000 high to low, and that's in the E-mini. In other words, they're getting up to 50% or more of margin. When that happens, it's prudent to put on a trailing stop. In other words, if you don't know how to define a VTE, valid to exit bar, then use a trailing stop. That's archive in the website, 19th of April. David, thank you for letting me know. I'll talk to Terry about that. I don't know why that's happened, but if you don't know how to find a valid to exit signal, then when you get that extreme volatility, it's sensible to put on a trailing stop. And a trailing stop can be 1 or 1.5 times ATR, the average true range. Now, all programs have a function for average true range, and set it. Usually the default setting is 7. You don't want to do that. What you want to do is use one of the Danielcode numbers, something longer than that. You can pick anything that suits you, but at some stage when you get that increased volatility, which we may be seeing again shortly, you will have to think about putting on a trailing stop, and 1 to 1.5 times average true range is the maximum. Never risk more than 1.5 times ATR. Okay, let's keep going. Here we Yeah, what do we see next? So this was the position we were at last night, and this is the S&P Emini, and you can see how this market's been struggling. It's been 1, 2, 3, 4, 5 days fighting against that 4210 blue line, and that's really showing some strong market resistance there. And of course, what happened is that we got a sell signal, which down it went. So this is the NASDAQ. I'm showing you this for a reason. The NASDAQ's diverging pretty markedly from the S&P equities. And in fact, yesterday, Morgan Stanley recommended some puts in various sectors of the NASDAQ. But the fact that the market's diverging is always concerning, and we've seen that between these equities for quite a while now. You can see the Danielcode signals are pretty fantastic here, and that's one of the reasons to start getting concerned. This is the real reason behind it all. This thing is sitting, believe it or not, at it's either 8 or 9 standard deviations from the mean. Now, this is the 12-day chart, and I'm using that because we can't fit the 6-day chart on a page anymore. I mean, you can, but it's so crunched up, it's just, you can't, it's become too much. It's gone too long to show. The 12 is fairly easy, and you can see we're at a massive level, 8 or 9 times standard deviation. At that February-March 2020 little flash crash, we only got down to 1, 2, 3, 4, 5, 6, 6 bars below the median. 1, 2, 3, 4, 5. I'm sorry, 5 standard deviations from the mean. It actually came from 3, 4 standard deviations above the mean. So in total, that whole move was through 9 standard deviations. Now, they're not your normal mathematical standard deviations. They're Danielcode standard deviations, which are different. But look where this market is now. It's battling against the highs there. It's got a couple of Danielcode 4th seal lines sitting just about right on those highs right now. So we're really on high alert for what happens next. Gold, I know we always have to talk a bit about gold, or our friends the gold bugs will get unhappy. I'll come back to you, Benjamin, if I may. So type any of your questions in the questions box, folks, please, and I'll come back and answer all of those when I finish this part of the presentation. So this was where gold sat at yesterday. It was sitting right on a blue line at 1908. And the rally on the 6-day chart's been pretty good. But here we are. It's been battling the US dollar index. So what happened today? Well, the US dollar index took off. You can see at the bottom part of that chart, the bottom half, is the US dollar index DX. And we had a TO3 plus buy signal 3 days ago, and it was elected the next day and looked really feeble, didn't it? In fact, it was a key reversal bar down, which is about as negative as you can get on a signal being elected. But nevertheless, we weren't stopped out. We're still long. And today, the US dollar index took flight and really got a serious push up. So that's what triggered the sell-off in gold. Remember how many times I've told you that gold and the US dollar index are often inversely correlated. It doesn't happen all the time. It can sometimes switch back to them being correlated in the same direction. But at the moment, as you can see from this chart, and the previous charts that I've shown you showing a longer term view of this, the US dollar index and gold are inversely correlated. So dollar up, probability is gold goes down, and that's exactly what happened today. We had a correlate, I should say more correctly, an inversely correlated sell signal for gold and silver today. both of which turned out to be pretty nice trades. So this is what happened in the US dollar index today. We had a TO3 plus buy right at the low. We had 3 days up, ran into a TO3 plus sell, gave us 2 days down, and then we had another key reversal bar to give us the TO3 plus buy signal. That trade was elected on Wednesday, and it looked horrible. It was a key reversal bar down and looked pretty negative. But today, sentiment changed, and off it went. And we got a really, for this market, we got a nice 2-day trade up, very much so. So what's changed? What caused the US dollar index to rally today? Well, one of the things, and it's fairly obscure, is that the rules of the US Congress, the rules of are kept by a person described as the parliamentarian. It's a lady at the moment. She looks to be a charming lady, and she makes rulings on the rules of Congress, and in particular the rules of the Senate, which are very, very complex. And until now, Chuck Schumer, the leader of the Democrats, now the majority, majority with a 50-50 with a casting vote with the vice president, had been thinking that he could have 3 or 4 goes at passing Biden's legislation with what's called reconciliation. I won't go into the detail of it. It's incredibly complex, but it means you don't have to have the 60 votes in the Senate to get legislation passed. And yesterday the parliamentarian ruled that no, they couldn't have 3 or 4 goes at it. They could have 1 go at it under reconciliation, which is the ability to pass legislation with 50 votes plus the vice president's casting vote in the Senate. And I think the plan has been that the Democrats were going to take whatever they could get from the GOP, pass that, and then come back and bite them with a couple of other bills that were more liberal, less acceptable to the Republicans. And that could have been, that's going to slow down this spending. I mean, my father used to say to me, money doesn't grow on trees. Well, apparently in Joe Biden's garden it does. I mean, the spending already and the projected spending is absolutely extraordinary. And somewhere, maybe sooner rather than later, that's going to matter. But anyway, the ruling of the parliamentarian yesterday for the US Senate rules is certainly slowing down that spend, which might have affected the US dollar to be a little bit stronger and more confident. This is a chart for coffee. I don't show you this very often, and I'm only showing it to you because one of our clients asked for it, and I prepared it for him. But this is a very good market, coffee. Coffee and sugar, incidentally, trade on the ICE exchange, Intercontinental Exchange, ICE. But coffee is a very, very good trading market. I trade it a lot. And you can see you had just an almost perfect TO3 plus sell, with the high of that bar being a handful of ticks away from the blue line. And today, of course, it gave us a nice sell-off. And the market went exactly to one of the red retracement lines, all of which are support. This is what happened in the E-mini today, folks. We had sell signals for all of the equities today. And remember, Thursday, seasonally, we even have seasonal bars in weekly charts, as most of you know, but Thursday is the best day for selling. And Friday is the best day for buying. So what we actually got here was a weak sell signal. The trade was elected, went down, then rallied back up. So what I would actually hope for is that we get a decent down bar tomorrow, Friday, but the probabilities are that we get a weak up bar. That's been the pattern forever on Fridays. It's the strongest up bar of the week. This is the NASDAQ that's progressed a little bit further. It had a TO3 plus sell signal 4 or 5 days ago. It's progressed a little bit further, but you can see how perfectly, this is another chart I don't often show you, that runs on a different computer, but it does exactly the same thing. You can see we had a TO3 plus sell signal, little inside bar, and then a nasty bar that stopped us out of the short trade, but we got that key reversal bar, which means you have to re-enter if you get a outside bar on the day of a new signal, because the failure point of the buy has been breached. You've seen that before. This is the Russell, same thing. It had a TO3 and a blue line sell signal. Actually, the blue line sell signal for the Russell was slightly different. It's on a different computer. The charts that you see, which are the gold standard, it had target recognition at the close on Wednesday, which was 2298.9 against, that was actually a black line signal, 2299.6, but the high was at a blue line at 2304.6 against 2303. So that I jumped off that too quickly. Let's go back. We had jumped off a couple of them. There we are. That's where we want to be. That was your blue line and TO3 sell signal. Same thing. The sell bar looked good, but then had a very significant rally, which may set it up for a buy on Friday. But I would be much happier with the state of all of this if we had a nice down signal. But we'll see. Either way, you can bet the Danielcode trading signals keep you the right way and making money. This is the Dow. Here's another one of those charts that you don't see often, but its TO3 sell signal came at a blue line, very close to a blue line. It wasn't actually a blue line sell signal because of the other conditions we require to make it a blue line sell signal, but it was a TO3 sell signal from a blue line. Same thing, trade got elected today and then rallied back almost to the open. Those of you trading currencies, of course, you've had a wonderful day. The US dollar index taking wings, even if they're very small wings, at least, triggered off some drama in the markets that are associated with it. This is the Aussie dollar Japanese yen, which really has nothing directly to do with the US dollar index. But we had a TO3 sell signal, and look at it. It was a nice trade. Down it went, plenty of money. This is the Aussie US dollar signal. Same thing. We had exactly the same. We had a TO3 sell, but of course the rally in the DX certainly helped this, and that's quite a big bar going down for the Aussie US dollar, which has been at pretty stupid levels for a long time. This is Euro AUD. Naturally, if the Aussie goes down, the probability is the Euro AUD pair goes up, because one part of the pairs is correlated. In fact, it's the same thing. So we had a TO3 buy signal for that market as well today. Up it went, gave you a nice trade. This is Euro USD. A couple of things to look at here. You could have that's the next one. I'm getting ahead of myself. This is just straight TO3 plus sell. You'll be amazed how many of these TO3 plus sells there are. Those of you who don't have the access to the TO3 plus, I urge you to consider upgrading to the TO3 plus because it does create a whole lot of signals that are very, very valuable. This is the Euro USD plunging down. This is the one I want to talk to you about. This is New Zealand dollar USD. Now, The Danielcode, when we started, it's very much designed for newbie traders. So what we do with the website is we say don't sell the highs or lows of inside bars. They're the little bars in red that you see. Sell the highs or lows of the last bar that it was not itself an inside bar. And that's the safe way to trade, because inside bars can be a bit tricky. But those of you who've done tutorials, of course, you know you have to trade the highs and lows of the inside bars. And look at the difference. Trading the low of the last bar that was not itself an inside bar gave you $770 on this trade into the close, whereas if you got short below the inside bar, it's showing at $1,210. Massive difference. That's not quite right, because after that inside bar, immediately after the TO3 sell bar that gave the signal, 2 bars later you had another inside bar, and if you were trading time you had to buy the high of that, and you'd have been stopped out for not a lot of money. Remember, when I tell you that there's been a failure on these charts, remember that for those who know how to trade properly, or who are following the instructions on the website, it's a relatively small amount of money. But that's what the New Zealand dollar, US dollar did today. This was copper. This is a big trade, isn't it, folks? Have a look. This is another one of those TO3 plus sell signals. Now, generally we expect the TO3 plus sell signals to be elected on the day they're posted. But as I've told you many times, it's worth bearing them in mind. It's worth writing them down and remembering them, because they often come a day early, which is what's happened here. And of course, we need our signals to come a day early. Coming a day late is like everyone else. It's just totally unacceptable. So this came a day early. And then the very next bar that you can see was actually Monday. That was the holiday. This market moved quite a lot, actually, considering it only had a few hours of pre-opening trading, because the markets were then closed. But if it's a holiday bar, treat it as a null or a void. Simply carry forward the last valid signal you had, which was a sell. That trade got elected the next day. Didn't look anything fancy, but we didn't have a profitable exit, and 2 days later we get a couple of decent bar and a big bar, and at today's close that trade's worth $4,700 per one contract, so certainly worth having. This is wheat, folks, and this is trading the Danielcode time signals, which is what we do on our 6S program. We use only time signals to generate them. Now, you can see in a couple of spots here I put the fail sign on. Having what I call a failed trade doesn't necessarily mean you lose money. For the worst case on this market, a maximum fail is $370. Very often it's considerably less than that, and sometimes you actually make profits on it. On this bar right here where I put the cursor, there's a time buy signal, and this market actually went up, from memory, about $400 or $500 before it turned and came back. And because when we think we're against the apparent trend, we're using a discretionary trailing dollar stop, we actually made money on the trade. In other words, we were wrong and we made money, which is great. So that is marked as a fail, but it actually made about $180 on the trade. And of course, then we got short the next day, $1,900 down to the low, $1,225 up to yesterday with a sell signal today, which has put us short again. So this is how the success signals work. If you haven't seen them yet, I suggest you do. You can see here 1,900, 2,000, 3,000, 42, $4,000 in, I don't know what it is, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 16 days. Pretty nice trading in a fairly quiet market, and it does very, very well trading time. Okay, so I think we must be near the end of our talk today, folks, because time is moving on. If you're interested in learning to trade properly, I suggest you think about doing a Danielcode tutorial. We teach you Forex and futures and a whole lot about time and other signals. If you are interested, please send me an email, jneedham@thedanielcode.com, jneedham@thedanielcode.com. And regardless of whether you're already a good trader or you've never seen a financial chart in your life, I will make you into an elite trader. So think about that and shoot me an email if you are interested. I'll send you some documentation. Okay, if you haven't had a free trial, folks, already, please go to the Danielcode website, www.thedanielcode.com, and just click the free trial link. Any problems registering, contact Terry, support@thedanielcode.com. If you previously had a free trial, it may be the computer remembers you and doesn't want to give you another one. But in that case, if it's a while since you had your free trial, contact Terry and he can organize that for you. This is our risk disclosure for you, folks. I do ask you to read it. It's very, very easy to lose money trading if you don't know how to trade. As I say every week, I beg you, I implore you, I get down on my knees to you and say, do not trade real money with futures or Forex until you are really confident that you know how to trade, because most people don't. 90% of new traders will lose their bank in the first 30 days. So do take the time, folks, and learn, please, how to trade. Okay, we have a few questions here. Let me go to those. The first one is, let's have a look here. This was from David. Yeah, our chart archives hasn't updated. I'll deal with that right now today. Benjamin says, website 19th April, big turn is identified, like the fourth seal. What do you think about buying leap put 2 years out and way OTM? I know you don't like options, which seem to be a decent way to play it while managing risk. Benjamin, a lot of our clients do trade options, and I know a number of them are already positioning themselves for the expected turn. I don't trade like that because the fact is you can't trade a 6-day chart, certainly not with futures or Forex. The leverage is too big. The risk on entry is too big. I will simply wait and take the signals that come from the Danielcode. Now, Danielcode's been public. The website's been up since 2008, which is quite a while. And I can tell you, I have never missed a significant turn in the equities market in all those years. So I'm certainly not going to miss the next one. If you want to play that strategy with puts, go ahead. It does seem reasonable. I'm dedicated to futures and Forex only. They're things I know a whole lot about. I don't know a whole lot about options, but yes, I understand what you're saying. So what have we got next? Mike, we learn fourth seal in the tutorial. Anything we don't learn, you learn everything in the tutorial. You learn the fourth seal. You learn absolutely everything. Jim, would you show soybeans, please? Can you look at soybeans or wheat and see where they stand and something or other? Oh, that was a mixed one. That part of that's Jim, part of it's Stephen. Soybeans, corn, and wheat. I certainly can, but they're on the other computer. So that's not going to help you guys. I'm sorry. Please email me if you have any specific charts you want to look at. And if you are a Danielcode member, I will be happy to create that chart for you and email it to you. Akshay, any update on the 30-year bond? T-bond, well, it's a turn today, actually. My gut feeling is the government is pressing that down. But anyway, it doesn't matter what my gut feeling is. Follow the signals. We had a, let me find this on the other computer. We had for US T-bonds, we had a sell signal, we had a buy signal, and then we had a time sell signal today in US T-bonds, which was elected, and we got short on our counter trend sell signal in success using a 1-bar stop. Okay, I think it's being forced down by the government, which is interest rate slightly up. Okay, so Stephen and Jim, my apologies, I can't show you more at the moment. That stuff is on another computer, but do email me. I can prepare those charts for you. Sean, great presentation. Thank you, my friend. I'm glad you enjoyed it. That's nice. What did Brian say? Can you use the fourth seal for super 401k investment decisions? Yes, you can. It's pretty fantastic. Get yourself subscribed to it. If you're not, you can get a free trial. At the moment, your free trial will cover everything except the fourth seal. We've thought, in fairness to the paying clients who are subscribed to the fourth seal, that we would not make it available to free trials for a couple of weeks. So you can see everything else there, Brian, but yes, that's what it does, and it does marvelously. As an indication, the article under the Articles tab at the Danielcode website is simply entitled 2020. That's an article that Frank DB, who runs the fourth seal, wrote for us in December 2019. And it said, stay long, the market's going to make new highs all the way into 2021. And even during the flash crash in February, March 2020, which was, it was some sort of a crash, he was saying, I don't care, the market's going to go on and make new highs. It's been pretty fantastic. And as I've said, if nothing else, we owe Frank a vote of thanks for keeping us essentially on the long side of the trade for those people who trade very long-term issues. Is there a minimum % correction that happens on a fourth seal turn, Benjamin? It doesn't have to be. Fourth seal turns, when time cycles are expiring, they're simply a vibration. We can get anything from nothing. The market can ignore the turn entirely. It switches on to a different time cycle. We can get a 1-bar counter trend or a 2 or 3 day correction like we did from the expiring 50 cycle, or you can get the biggie. And we only know that by following the trading when it happens. Stay close to the daily signals as well as the fourth seal. You should be aware of the longer term trends that the fourth seal is identifying. Once you've done that, you need the daily signals to actually enter the trades with an acceptable risk management. Okay, so thank you for being with us today, folks. We're a little few minutes after time with a really good turn up today. I'm so glad you came, and thank you for being with us. Vicky, I didn't see you arrive at the time, but welcome. Another lady who's often with us, and great to have you with us. So that's it for today, folks. Anything in particular you want me to talk about next week, send me please an email, jneedham@thedanielcode.com, and let me know, and I'll have something prepared for you at our next webinar, which will be next Thursday as we go back on our regular cycles. So enjoy your weekend, folks. It's Friday here down under. It's a beautiful sunny day, even though it's early autumn, and the Pacific Ocean is sparkling blue and still warm enough for swimming. Thanks for being with us. I'll talk to you soon. Thank you, Rolf. Great. Yes, have a safe, excuse me, and fine weekend yourself. Thank you, Martin. Appreciate that. Bye-bye for now.